Welcome everyone to this freight market update. Just so we're on the same page, this is getting filmed a week or two before Thanksgiving right now, so we're still actually digesting a lot of October economic information coming out. But with that being said, we're past the election. I've not seen this much excitement in the freight community since, I'm going to say, maybe this first or second quarter of 2022, and it's good to see that excitement. So it's a nice change of pace. However, this is also one where, sort of like the Fed, is supposed to pull the punch bowl before the party gets good. I'm here to also sort of provide a dose of the reality of where we're at now and how we can start thinking about 2025. So from a demand standpoint leading off, the good news is the trucking 10-mile index I co-author with Yembo Yamo at the University of Tennessee, it is pointing to Q2 of 2024 being the low point from a pure freight demand standpoint on a seasonally adjusted basis. We did see a little bit of an uptick in Q3, albeit not much. What I keep cautioning folks is, since manufacturing is still the source of most for-hire trucking freight, it's going to take a while till any new orders percolate through the system. So I've been, saying for many months, Q1 to Q2 of 2025 is when I start to expect to see a significant increase in demand, to the point we start to see a sustained shift in the market. And by market, I'm talking pricing. So if we take a look, we have seen a little bit of a rebound in spot market truckload prices. As of filming, they're at $2.03 a mile, including fuel per DAT. It's up about a cent from October. October was up 5 cents from September. So the good news is we're again on an upward trajectory, but here's again the dose of reality. We're neutral, if not down a little bit over last year. Yes, diesel is cheaper, so an inferred line haul rate will be higher. But historically, when we see spot rates break out of essentially a trough, it's even including fuel surcharges, like we observed in late 2013 into 2014, like we observed starting in the second quarter of 2017 through much of 2018. So I really want to see that red series start to show a sustained uptick that's beyond seasonality before I get excited. And essentially reinforcing what the spot rate data is showing, the Bureau of Labor Statistics Producer Price Index for the commoditized portion of the dry van truckload sector was effectively neutral here again in October, year over year. Again, that's a index that has fuel, so on an inferred line haul basis, we would be higher. But again, we're not looking at those big upticks like we started to see in the second half of 2017 through 2018, or certainly starting in the second half of 2020 through about the second quarter of 2022. So what I'd say is there's reason to be excited. There should be some tailwinds for demand as we move into 25, but we do need to, keep everything in perspective right now. Then lastly, what I wanted to talk about is a metric that at first glance doesn't seem that related to freight volumes, but it's something every trucking company needs to be monitoring as we move into 2025. And that is the core consumer price index, so excluding food and energy. And the reason for that is core prices are what the Federal Reserve focuses so much of their attention on when they talk about how to raise or lower interest rates. And while the Fed uses the core personal consumption expenditures price index as more weight, core CPI is a very important metric that a lot of economic forecasters look at. Right now, it is persistently stuck at the moment at about 3.3% year over year increase. Now, from a long-term historical standpoint, that's better than we were in the 1980s, and certainly much better than we were in the 1970s, especially after the first oil shock that occurred in 1973. However, 3.3% is high on a historical basis. And so the reason I'm saying we need to monitor this is as we move into 2025, if we start to see signs that core CPI picks up for whatever reason. So if we start to see this move from 3.3% year over year towards, let's say, 3.5% to even 4%, that's going to affect how the Federal Reserve thinks about lowering interest rates. We've already seen 75 basis points of cuts over the past couple months. That will be a tailwind for freight as we move into 25. We're expecting another 25 basis point cut in December. original economic forecasts were calling for another 100 basis points of cuts in 2025. But if inflation stays higher than the long-run target, we may see that rate of decrease slow. If it starts to pick up, we'll see that rate of decrease stop. And so if that happens, that's going to be less housing activity, less investment activity, which does mean less freight. So this is one of those indicators that we may not think about as much, but we definitely need to be watching as we move into next year.